Excellent.
South on in April of 142!
You heard the monkey. Make the trade.
Turning to the stock market, Animotion is up an 8.
Woohoo! Go up!
What's up, guys? It's Jason here, and welcome to my YouTube channel, The Death of Mutual Funds Insight. In the late 1980s and in most of the 1990s, mutual funds were all the rage in the US. While mutual funds are obviously still traded and relatively popular today, ETFs come up in conversation just as frequently among anyone even with a bit of financial knowledge or at least a 401k. Similar to many other financial terms, typically when someone throws around the term mutual fund, it sounds like jargon. Something only a specialist or expert would know how to explain. In fact, if a YouTuber stopped you on the street to ask you what a mutual fund is, would you even be able to explain? Luckily, you don't have to answer that question today. Put simply, a mutual fund is a professionally selected and managed group of stocks, bonds, and other securities that allow individual investors to access a diverse range of investment options while spending less money. Mutual funds have different themes which are decided by the individual investment company that owns them. For instance, a mutual fund could be ESG-themed, in which case they offer shares from companies that have a positive track record or are on their way to being sound in terms of their environmental, social, and governance policies and actions. This could range from companies like oat milk producer Oatly to environmentally friendly baby and children products companies Honest, founded by actress Jessica Alba. Alternatively, a mutual fund could be country or region-based, with an emerging market theme offering shares from Chinese, Indian, Russian, and Saudi Arabian companies. A company that is included in the mutual fund does not own the mutual fund and is not involved in its management. Rather, the financial company that is offering the mutual fund, such as Fidelity or T. Rowe Price, own and manage their mutual funds. Today we'll go over the story of mutual funds, why people enjoy mutual funds, the rise of mutual funds, and why are mutual funds losing popularity with the decline of the mutual fund industry. With that, you'll know by the end of this video why you should sell your mutual funds today. But before we begin, if you wouldn't mind just tapping that like button for the YouTube algorithm, I would really appreciate it. The more engagement a video like this gets, the more likely the YouTube algorithm is to push it out for more people to enjoy. And as this is a brand new channel I started this year, I appreciate it a millionfold. To add to that, I also respond to all comments and feedback. If you love to make money, be sure to subscribe and hit that notification bell for new videos each week. Thanks for doing that, and now let's continue on with the rise and fall of mutual funds. Why mutual funds? The fundamental appeal of mutual funds is that you can get a lot of bang for your buck. Let's say you're interested in investing in the electric vehicle space, especially in one of the most famous EV companies, Tesla. But you don't want to invest $600-something on just one Tesla stock. An electric vehicle or green energy mutual fund that includes Tesla and its Chinese counterpart NIO is one way of investing in multiple green companies without having to invest your life savings to buy relatively few shares of big-name companies. In fact, many mutual fund companies allow individuals to start investing for as little as $1,000. To put that relatively low figure into context, just one share of Amazon stock would cost more than $3,000. It means you could invest in a mutual fund and thereby access a group of stocks for less than it would cost to buy into Amazon at the moment. Another important reason for its one-time popularity is that they're professionally managed, and the stocks that compose your mutual fund of choice are pre-selected by the management company. Interestingly, about 71% of polled Americans rate themselves as financially literate according to a FINRA study. Yet, in 2009, only 42% of polled Americans were able to answer 4 of 5 financial literacy questions correctly. By 2018, that dropped to 34%. Despite that disparity between some Americans' perceived and actual financial knowledge, mutual funds are still used today, in part because they require minimal input from individual investors about which individual stocks are best or which stocks to choose. There's no need to wait to become more educated about individual companies to make the best decision. Instead, individual investors really only need to have an idea about which investment themes or flagship companies they would like to invest in. For investors who don't feel confident about their financial knowledge or don't want to spend time daily checking investment apps such as Robinhood or Acorns, mutual fund managers get paid to do that. Typically, they actively manage the funds by making decisions about when to reinvest gains or distribute them to their mutual fund investors. Capital gains or losses by mutual fund managers are passed on to the investors. Win or lose, you pay for the mutual fund manager's decisions. You might have already guessed it, but mutual fund managers have a strong incentive to maximize investors' returns. Their compensation is tied to the fund's performance. Popularity in the 80s and 90s. All of those strengths helped mutual funds become most popular in the 1980s and 1990s, with the term seemingly thrown around by everyone from soccer moms to Wall Street professionals to your average 9-to-5er. Despite that fairly recent popularity, in actuality, the first mutual fund, the Massachusetts Investors Trust, was created in 1924 in Boston. By the time the stock market crashed in 1929, prompting the Great Depression, there were already 19 open-end mutual funds in the United States and 700 closed-end funds. The difference between open-end and closed-end mutual funds is that open-end funds are available for investors to buy shares at any time because they can issue more, whereas the latter have a fixed amount. These days, mutual funds are mostly open-end funds. Considering the long history of mutual funds, why the boom some 3 to 4 decades ago? One of the main drivers was the blazing bull market of the 1980s, fueled largely by President Ronald Reagan's business-friendly policies of reducing interest rates and promoting economic growth. Buy orders flooded the New York Stock Exchange, with the decade seeing its highest then trading volume. Investors and fund managers were optimistic about the gains that could be had with the stock market rather than their traditional investment vehicles such as antiques and real estate. Mutual funds were the next big hot thing because they were seen as less risky than tangible assets while still spreading risk better than an investment in individual stocks. The rise of tax-exempt accounts such as Roth 401ks and the tax-deferred accounts such as Kyog Plan, which is a tax-deferred pension plan, also fueled the mutual fund boom. In fact, while today 401k and pension plans seem like a given, in reality the 401k plans were only instituted by the IRS in 1981. In 1983, $5.9 billion in mutual funds made up IRA investments, while in 1985, that amount had grown to $18.6 billion. That fast-tracked growth just so happened to dovetail with famed money manager Peter Lynch, managing the portfolio of the Fidelity Magellan Fund between 1977 and 1990. In those 13 years, he averaged a 29.2% annual return, which was more than double the performance of the S&P 500. Though by all means an atypically long and impressive victory lap, Lynch showed that with expertise, mutual funds could outperform even an S&P 500 index fund, which matches the performance of the 500 companies that make up the S&P 500. The fortuitous meeting of a very long bull run, President Reagan's tax policies, and increased awareness about mutual funds because of all-stars like Peter Lynch helped stock funds grow so dramatically that one research firm showed that in 1982, 5.2 million Americans owned mutual funds, but no stocks. Just a year later, in 1985, the same study showed that mutual fund ownership with no stock ownership almost doubled at 11.2 million. Indeed, at the beginning of the 1980s, a bit over 500 mutual funds existed. About a decade later, the number of mutual funds increased to about 5,000. That's a 900% increase. For mutual fund companies, managers, and the retail investors who trusted them with their money, it was probably a good thing. Too much of a good thing can turn sour though, and while mutual funds haven't gone away, they have to compete for investors' attention in a much more competitive landscape these days. Becoming less hyped. Mutual funds have grown in leaps and bounds since the 1980s and 90s, but it doesn't have the same cash as it once did for a variety of reasons, spanning the rise of apps like Robinhood to the 1997 tech bubble bursting. The dot-com tech bubble of the 1990s was fueled by the rise of software and tech startups overall, riding off the ostentatious and very real wealth of the 80s. Fundamentally, once personal PCs and the internet started becoming more accessible, more Americans were eager to invest in any so-called .com company ending in the now default .com domain, causing a high spike in our speculative bubble and some of the first online shopping sites such as Pet.com and telecommunication companies such as WorldCom. The frenzied trading by retail investors eager to get rich quick, in turn, encouraged .com companies to operate on losses and market themselves at any costs. In 1999, then chair of the Federal Reserve, Alan Greenspan, raised the interest rate a few times in order to temper the investment frenzy. Shortly after, in 2000, Japan entered a recession. Those major factors contributed greatly to the economy's subsequent tailspin, with the Nasdaq Composite Index falling by 25% in the week of April 14, 2000. How is the dot-com tech bubble connected to mutual funds losing their luster as an investment vehicle? Essentially, it led to a weariness to invest as eagerly, even if with a money manager. In addition, as mutual funds became less trendy, they gave way to passively managed funds called exchange-traded funds, or ETFs, which were actually around since the 1990s. ETFs and mutual funds are both ways for individual investors to invest in different stocks, collectively themed. However, passively managed in the case of ETFs means that they're designed to track whichever indexes are relevant to their collection of stocks. For instance, if you're interested in buying an S&P 500 ETF, guess which index it tracks? Besides that, it mainly distinguishes itself from mutual funds by being traded often throughout the day while the market is open, unlike mutual funds which are traded just once a day and after markets close. The higher liquidity that ETFs offer relative to mutual funds because they are traded so often means that investors could sell for cash faster than mutual funds. It becomes a safer option because your money is less tied up when you may need it or want it. It was the perfect alternative to mutual funds after the dot-com tech bubble. ETFs offered the potential to make money, but with less of the cost and risk associated with mutual funds. And that brings us to today. The rise of apps like Robinhood, which was founded in 2014, added to the whirlpool of investment choices that make mutual funds less of the go-to money-making option for non-professional investors. The California-based app is a brokerage that has no commission fees for trading. ETFs can be traded on Robinhood, but mutual funds cannot. As of 2021, Robinhood reported that it had 17.7 million active users. As of 2020, about 45.7% of American households owned mutual funds. That seems very impressive, except when you take into account that mutual fund ownership by households has barely increased by a full percentage point since 2000. To put that into context, in 2014, Robinhood had 340,000 people on its waitlist. A month before it launched in March 2015, that waiting list had grown to 700,000 people. It reached 1 million users in 2016, doubled by the next year, tripled by 2018 to 6 million, with its local transactions growing at an equally rapid pace. In 2016, its total transactions were only $0.5 billion, while the next year it was $50 billion. By 2020, it had increased by 600% to $350 billion. Startling growth for an unconventional brokerage. While zero-commission brokerage seems just as intuitive now as 401ks did, before Robinhood, brokerages typically charged $5 to $10 per trade and required a minimum deposit of $500. Robinhood and competitor apps changed the investment game by offering anyone with interest in investing the chance to do just that. No need for a money manager, no need to bank much of your retirement income on 401k and mutual fund returns. Anyone can be as big or small of a risk taker as they choose and check their investments in real time with the app. It doesn't mean mutual funds are dead, far from it. They are, however, suffering from the same problem as many other industries. With the advent of the internet, more competition for a share of people's wallets and attention. So with that said, thank you so much for watching my video. There was a significant amount of research and production that went into making this video possible. As this is a brand new YouTube channel I just started this year, if you enjoy videos like this, please click the subscribe button and hit that notification bell. I respond to all comments. If you haven't seen already, check out my video on the rise of Coinbase, or what does it mean to be wealthy in 2021. As always, stay happy and healthy and stay tuned for another episode of Company Insight next week.